Before we start, a bit about us. So, as Dan said, we're the only firm who work exclusively with startups and high growth businesses. The reason for that is that startups, as you guys will know, are sort of quite niche in what they do. And from the legal side, it's important that things are tailored to the startups. That is especially the case when it comes to raising investment. So we'll have a look at some of the quite specific tax relief schemes that are used by investors in startups. So some of you may have heard about SEIS and EIS. They're very, very complicated. They're quite simple in theory, but there's a lot of detail around them. And it's one of those things, if you work with them every day, they're nice and easy. If you try to do bits and pieces of it, then they can be quite tricky. So this is very much what we do. Stuff we're going to cover, so I'll talk a little bit about the market, look at some source of investment, touch on angel rounds and the tax release available to them, have a little bit of a think about the investment process and documentation. I'm just going to jump very briefly at that point into advanced subscription agreements and sort of by extension convertible debt, and finish with just some slightly techie stuff around calculating valuations. And the only reason I finish with that is because a lot of our clients in those sorts of initial conversations we have with them, they've actually calculated their valuation wrong. And it can be a really expensive but really, really common mistake to make. So I'll just finish off with some examples of how to calculate. So where are we? The good news, I think, surprises people a lot actually. But the good news is that the investment market is great. Raising investment for startups is relatively easy. Valuations are really high. There's loads of investors in the market. Basically now is a pretty fantastic time to raise investment. But by way of background, where this sort of has come from. So, the London market has been very, very good for the last decade or so when it comes to raising investment. But what we have at the moment is a really, really buoyant investment market, way better than the situation pre-COVID. And I think that comes from a couple of things. Number one, a lot of investors weren't playing in the market. They weren't making investments during the pandemic. Now they are. You've got all this pent-up demand. Number two, I think a lot of angels, or the makeup of investors in the market has changed since pre-COVID. So pre-COVID, the vast majority of startups did their sort of early stage rounds with angels. And the argument was that you could get better valuations, better terms, angels took less control, had less rights. And overall the deal was better. And the thing was, angels were doing really big rounds. So, the year before COVID, we had a couple of pure angel rounds where clients raised more than sort of £2.5–3 million. So quite big rounds with angel investors. What I think happened with COVID is that angels realized that, they were reminded perhaps that investment in startups is extremely risky. And so to give an example, we had a couple of investor clients who had invested quite heavily in travel tech. Now, travel tech pre-COVID was viewed as actually a relatively safe bet. If you invested in the right sort of companies and you could get them to sort of get some traction and growth, they were actually pretty good investments. Now, as you can imagine, travel tech was not the space to be in the middle of the pandemic. And so a lot of those companies went bust, or at the very least were sort of put on ice. And my read is that a lot of angel investors found that relatively concerning and perhaps sort of second guessed their ability to judge what is sort of the right business to invest in. And what happened is a lot of the angel networks, a lot of the individual angels came together in early stage VCs. And so what you have in the London market at the moment is really an explosion of early stage investment funds. And, that's great for, pre-seed rounds with, early stage startups looking to raise money. You've got lots of these early stage funds. They're all competing on valuations. So valuations are still pretty high. Actually, the terms that they're offering are in general pretty good and quite competitive. And there's been a knock-on effect, which is that the later VCs, what pre-COVID would have been the sort of the bigger VCs doing Series A, a lot of them are now doing seed rounds. They are prepared to invest earlier. And my read is that is because they're facing more competition when it comes to source of funds. They are actually now investing earlier than they would have done pre-COVID. Basically, the short version, all of that's great for startups. Now is a pretty good time to raise. When we think about sources of investment, there are a number of sort of standard places to find investment, or standard people who will invest. And there's a number of things that people sometimes don't think about. So I just wanted to just quickly skate through the sources of investment. If we just start with grant funding, and the reason I raise this is that so many businesses in the for-profit space forget grant funding. Grants essentially, in almost all circumstances in the UK, are free cash, and we all quite like free cash. They're available to businesses that are doing something particularly innovative. But just to be clear, you don't need to be, firing satellites into space or, creating vaccines. There are a number of tech grants for businesses doing things that are technically innovative. Lots of stuff in the fintech space. The place to look for grant funding, certainly on the sort of for-profit side, is Innovate UK. And Innovate UK is the UK government's grant body. One of the positives of COVID was that the government chucked, I think it was £1.5 billion of extra funding at Innovate UK. So there's a lot of money there for innovation. And the grants, though they are highly competitive, if you can win grant funding. It's a really fantastic way of funding early stage innovation, but also actually, frankly, of encouraging investors to invest in your startup, because investors love grant funding as well. Because if you think about it, the company's got a whole bunch of value that it doesn't have to repay, that it isn't equity that's been given away, and doesn't dilute the shareholders. So it's sort of a win-win for everybody, if you like. My top tip on grant funding, though, would be don't bother applying for grants that are not key to what your business does. One of the biggest mistakes that I see people make is, they're in a particular space, they're doing something, and they see a grant that is not what they're doing, but is sort of similar, and they think to themselves, I know what, I'll skew my business slightly to get this grant funding. Basically, it almost certainly doesn't work. They're highly competitive grants. If what you're applying for is not key to your business, you're probably not going to get it. And the reality is, to get a successful grant application in, you have to spend a lot of time, a lot of energy, and quite frankly, probably a lot of money to get that application right. It just doesn't make sense if it's not key to what you're trying to do. If it is key, go for it. Great source of money. So then when we think about raising investment, the traditional pre-COVID route, and it's still applicable to some people these days, was that you start by tapping up your friends and family. And that is literally what it says on the tin, asking your mates and your poor parents for some cash. Generally, for most of us, our friends and family are not insanely rich. God, imagine if Elon Musk was your dad, brother, whatever. That would be pretty cool. But anyway, it's generally fairly small amounts of money. You're probably giving away equity, so you're issuing shares to those people as investors. But it's sort of early friendly stuff designed to probably get your sort of business plan sorted, cash flow sorted, maybe get a prototype of your product out there, but fairly early stage stuff. Pre-COVID, the theory was, once you've done that friends and family, you've got your business just about started, you would then go and raise angel money. So angels are relatively high net worth individuals, often bankers, lawyers, startup founders who've managed to exit. They tend to be looking for two things. So they're looking for a business that will grow and scale. So in other words, they can sell their shares in that business for a multiple of what they paid for them. So number one, business that will grow and scale. And then for UK angels, number two, they're looking for tax relief. We'll talk about tax relief in a sec, but the crucial thing here is, for UK angel investors, tax relief is absolutely vital. I saw a statistic a couple of months ago. I think it said 93, 94%, I think it was, of angel investors in the UK market invest and claim tax relief. And so, as you can imagine, tax relief becomes vital to them. If they can't get it, then they are less likely to invest in your startup. So that's angels. Pre-COVID, theory was you did one angel round, maybe multiple angel rounds, but at some point you wanted to grow and scale your business. So you wanted to enter a new geographical market. Maybe you wanted to launch a new product line. Maybe you just wanted to spend a huge amount of money on marketing and getting sort of customers onboarded. And at that point, you'd need to raise a load of cash. So you would go to a venture capital firm. So venture capital firms, VCs, they are, if you like, professionally structured funds. The money that is behind them tends to be a mix of very high net worth individuals, corporate money, some pension funds sometimes, so institutional money, and a good dose of government money. So the British Business Bank is the government's sort of startup bank, if you like. They will invest, or they will put money into a lot of VCs, and that is how the government sort of invests, how it provides funding to the investment market. So VCs often have a lot of government money sat behind them. By the way, it's not just UK government money, it's also European Central Bank money as well. So you'll find that there's a lot of VCs in the UK market who are actually funded by ECB, so the European Central Bank. Exactly the same principle as UK funded ones. But yeah, government money sat behind it. Now, as I said at the beginning, where we are now post-COVID, hopefully post-COVID, is that a lot of those VCs are coming in earlier. So a lot of them are actually replacing angel rounds. So it's pretty common amongst our client base that they will have a business plan, have a rough prototype, and off the bat raise a VC round. And so that is now something that is sort of realistic and possible. I want to talk very briefly about crowdfunding. You guys, I'm sure, have heard of SEIS, Crowdcube. Those are FCA authorized, so regulated platforms. And what they do is they bring together a whole group of disparate investors, mostly angels, to invest into startups. So if you want to use those platforms, what you do is you work with SEIS or Crowdcube. You create a slick video, you provide a bunch of information to their platform, they create a profile for what they call your campaign, so your investment round. And then they basically market the hell out of your business. They have insanely good marketing networks and great SEO. And the idea is they bring a pool of investors to your business and they help you raise your round. For what it's worth, both platforms extremely good. They both have positives and negatives, which we can talk about if anybody wants to know at the end. But basically, I would say actually very good platforms, and they serve a very important role in the UK market. But in order for a Crowdcube round, in order for a crowdfunding round to work, generally you have to bring between 30 and 50% of the amount of money that you're trying to raise to the platform from your own investors. So you're trying to raise a £500,000 round, probably you need to bring 250,000 quid worth of investment to the platform yourself in order for the campaign to be successful. And the reason for that, it's that sort of, that idea of sheep and people follow, sheep following what their colleagues are doing. Nobody wants to be the first person to invest in a round. But if they see everybody else is investing, then they get FOMO. They're afraid that they're missing something and they'll chuck some money at it. So what you do is you drip feed money from your own investors into the campaign so that people see progress and people see that the campaign target is getting closer and closer, and that encourages them to invest. What that means in practice is almost certainly before you can effectively do a crowdfunding round, you actually need to have done an investment round and have some investors who'll follow on and put that initial sort of money in. The second thing is, as a slightly cynical lawyer, to me, crowdfunding, yeah, it's about raising investment, but actually more valuable here, it's about client acquisition, bringing on users. And the reason is these crowdfunding platforms have got insane marketing networks, as I said a second ago. And really, a huge benefit of using them is being able to get your product out there, get your business known amongst a whole bunch of people who are essentially a captive audience, right? They're people who are interested in startups, want to try the new stuff, very likely actually to be interested in whatever it is that you're doing. So you want to be able to market to them. That means that you need to have the ability to onboard them as customers or users. So again, that for me, the time to do crowdfunding is when you've raised some investment, you've got a product, it's in the market, and you have the ability to onboard new customers. And you basically use and abuse the crowdfunding platforms as a way of bringing on users. So for me, it's not, you don't do crowdfunding as your first round, you do it a bit later when you're in that sort of position. I wanted to talk very briefly about ICOs. So what we're talking about here, token generation events, so crypto stores. It's less the case now, but I would say probably 3-4 years ago, almost every pitch deck I saw had a slide on it saying, we're going to do an ICO, we're going to do a token generation event. Thankfully, that has stopped. What I would say is, and so I should say, a token generation event is essentially where the company issues a token to investors that obviously they pay for that token. And without going into the detail of it, there are broadly two types of token. There are what we call security tokens. So those are effectively equivalent to shares. And the crucial thing is, if you wish to issue a security token, you are carrying out a regulated activity and you fall smack bang into the middle of the financial services regulations. And so you have to get this stuff right. You don't issue security tokens in the UK market effectively. The second type of token is a utility token. And theoretically, utility tokens are not regulated, albeit, again, for lots of good reasons, you don't really issue utility tokens in the UK market. What you do is you set up a structure abroad, somewhere like the BVI, Gibraltar, Malta, those sorts of places, where they have a clearer regulated regime, and you deal with it outside the UK. But utility tokens are basically tokens that give you a right to a particular good or service. So let's just imagine that as a law firm, we were to issue a utility token. That might give you per token the right for an hour's worth of legal advice. So anyway, companies can issue these as a way of onboarding money and sort of raising investment. My take would be, if you are in the crypto blockchain space, then doing a token generation event may well make sense. And that is something that rationally probably, is a sensible thing to look at. If you're not in those spaces, you're doing something completely different. From my perspective, it doesn't really make sense. They're hugely expensive to operate, and they're a hell of a lot less popular than they were, particularly as crypto has massively tanked in the last couple of months. So I would say, if you're not in the crypto blockchain space, focus on raising investment the boring traditional way, and don't sort of put too much energy into token generation events, because to me it doesn't make sense, and we've had a number of clients who've gone down that path, and it frankly hasn't really worked out for them. The final one, convertible loans, which we'll talk about one of these structures at the end. But convertible loans are effectively structures that are loans. So people lend money to your company, and then if that loan is not repaid, it can be used to buy shares in your company, perhaps at a discount to the next investment round price. Convertibles are used by VCs and angels. They are becoming more common in the UK market because, well, primarily because the British government used them in the Future Fund, which was the government's sort of attempt to help startups during the pandemic. That Future Fund used a convertible loan. As a result, they are probably a little bit more common than they used to be. But as I say, we'll talk about those at the end. So if we go back to angels and we think about what I said about angels. So angels are looking for two things generally. They're looking for a business that will grow and scale, that they'll be able to sell their shares at for a multiple of what they invested at, and they're looking for tax relief. So I wanted very, very briefly to explain to you the way that the tax reliefs work. There are two tax relief schemes that we primarily are thinking of here. The first one is called the Seed Enterprise Investment Scheme, so SEIS, and that's the baby one, and that applies to the first £150,000 that angels claiming tax relief invest in your startup. And then the second scheme, the Enterprise Investment Scheme, EIS, is the bigger scheme. It applies to the next 10 to 12 million pounds that you secure from angels claiming tax relief in your startup. Now, what these schemes do is they give investors a percentage of what they invest back from HMRC as a credit against their income tax liabilities. So to be clear, this is only individuals we're talking about. It doesn't apply to companies or anybody else, just individuals. And the origin of these schemes was back in the 90s, early 90s, when you had the the Major government, I think it was. or maybe actually, I think it was probably even Thatcher government, so even further back. But anyway, what you had was a slightly bizarre economy. So the economy was doing really well. You had lots of, being flippant, rich people, but you had a very high unemployment rate. And so John Major, I think, who was the Chancellor at that point, he said, well, what can we do to bring the unemployment rate down? And he came up with these schemes. And the idea basically is that you incentivize rich people to make high-risk investments in startups. That means that startups have funding, they go away and employ people, and that reduces the unemployment rate. These schemes have worked in absolute trees. And I would posit that, frankly, the reason we're having this presentation today is actually very largely due to these schemes. They really did underpin, and increasingly do still underpin, the UK startup market, and they are massively, massively used. So how do they work? They are for investors making high-risk investments. So it's in startups. There are age limits. Under SEIS, the company must be less than 2 years old from the point that it started generating revenue, so from commencement of trade. So the date that you got your first revenue, 2 years after that, you cease to be eligible for SEIS. So you need to obviously make sure that you understand what your commencement of trade date was, and you're raising SEIS money before the end of that period. EIS is 7 years from commencement of trade date, but it can be extended in certain circumstances. Investors have to have full risk, what we call ordinary shares. So basically, they can't have any protections. They can't have security over assets. They can't have multiple voting rights. They can't have multiple dividend rights or ratchets on sale. They have to get normal shares and effectively be treated the same way as the founders. So how do the actual reliefs work? Let's take SEIS because it's the easiest one, and I'll jump onto EIS in a sec. So let's imagine that I invest £100,000 into a startup under SEIS. So as long as in the tax year that I make the investment or the preceding tax year, I have paid or will have to pay £50,000 worth of income tax, so half of what I invest. As long as I've got that much of an income tax liability, HMRC will give me back up to 50% of my investment amount. So I've invested 100,000, I get 50,000 back from HMRC pretty much straight away. So straight away, I'm only at risk for £50,000. And if you think about it, that means that I could potentially sell my shares at a loss, call it £75,000, and actually still make a profit. So this is already quite a good deal for me. If in the tax year I have disposed of an investment asset, so I don't know, rental property, listed company shares, and because I'm a lawyer and my maths is awful, let's just imagine that I make £100,000 gain on my rental property. If I invest that £100,000 into the startup under SEIS, I only have to pay half the capital gains tax that I would normally have to pay on the disposal of the rental property. So for simple numbers, let's just imagine that the capital gains tax is at a 20% rate. Rather than pay 20%, £20,000 on the £100,000 gain, I only have to pay £10,000. So I'm £10,000 up. I still get the upfront 50% income tax relief. So I've invested 100, I've got 60 back. I'm only at risk for £40,000. Now, shares in so SEIS shares must be held for 3 years in most circumstances. So let's imagine I've held my shares for 3 years, and then just over 3 years after I invest, fantastic news, the company sold for 100 million quid. I make an absolutely massive gain. That gain is 100% tax-free under SEIS. So I pay no tax whatsoever on any gain that I make. Now, one of the really interesting things about these schemes is investors focus on that upfront income tax relief, that 50% cashback from HMRC, because that's what reduces their upfront risk and makes them feel that this investment in a startup is less risky. But the reality is that the really exciting bit is if the business does well, they exit tax-free and they're in an insanely good position. To put it in numbers, we had a client at tech, quite a complex tech client that was sold just before Christmas last year for about 125 million. there was an investor in that startup who had put in about 450K, I think, from memory, under SEIS and then a bit more under EIS. He sold his shares for about 18 million, 100% tax-free, makes for an extremely happy investor. So that's all the upside stuff. There is also downside protection. If the business doesn't do so well, it goes bust, or you make a loss on your investment, there is then something called called loss relief that kicks in, and loss relief goes some way to compensating you for the loss that you suffer. To be clear, it doesn't go all the way. It doesn't compensate you for all of your loss, and the amount of your loss that is protected very much depends on your personal circumstances, your personal tax position at the point the loss is crystallized. So it's quite a complex tax relief to calculate, but at a headline sort of terms, it gives you a little bit of downside protection as well. EIS, very, very similar in practice. The key differences are the upfront tax relief is 30%, not 50%, so it's a lower upfront tax relief. The capital gains tax relief is slightly different. So rather than you getting off having to pay half the capital gains tax on the disposal, what happens if you dispose of your rental property is that the capital gains tax that you have to pay is deferred. So you don't have to pay any of it now, but when you dispose of the EIS shares, you'll then have to pay the capital gains tax that you should have paid on the disposal of the rental property that you reinvested the money. So it delays the tax. Amusingly, a lot of investors will reinvest and reinvest and reinvest in order to effectively never have to pay that capital gains tax. But yeah, it's a deferral rather than anything else. Otherwise, EIS in headline terms is pretty similar to SEIS. Key requirements. So from a company perspective, the key things I think to be aware of, the company must be carrying on what's called a qualifying trade. The good news is a qualifying trade covers actually pretty much 80% of what startups in the UK market do. So the things it doesn't work for, property development. If you want to go and develop property, you ain't going to get, investors won't get tax relief on it. So property development doesn't work. Anything that is utilising property. So if you think about, I don't know, provision of serviced offices, that's not going to work because you're renting out property. Also, rental of assets. So there's a distinction here. Let me give an example. So imagine you create a tech platform that facilitates car rental companies renting out their cars to customers. So what you do is you sell a contract to your car rental company. They put all their assets onto their platform, and you do lots of cool SEO and marketing stuff, and you attract people who want to hire a car to the platform. That is qualifying. That is a tech business. Tech businesses basically work. The crucial thing is you are not renting out cars. You're not in a rental business. You are a tech platform business. By contrast, if you were to set up a car rental company and you were to rent out Aston Martins to people, at that point you wouldn't qualify. You're carrying out renting. You are leasing items, and leasing items doesn't qualify for the tax reliefs. Other things that don't work. Banks don't work. So the guidance says that certain types of financial services business do not qualify for the tax reliefs. But the good news is that almost all fintech does. And by the way, you can be FCA authorized and still qualify for tax reliefs. What doesn't work is a couple of things. So the primary one is where you're holding client money, that doesn't qualify. Where you are carrying out sort of proprietary trading, or you're taking risk on behalf of customers, that also doesn't work. So things like banks don't work. In insurance space, things like acting as an underwriter, where you actually carry the risk, that doesn't work. What you find with fintech businesses, so a lot of fintech businesses are brokers. That's fine actually in almost all circumstances. Even in the insurance space, underwriters who are not carrying risk, I can't remember what the hell they're called, but where you're effectively a broker, but you do some of the underwriting activity for the eventual underwriter, that's actually all fine as well. You know, businesses that, you know, even provide, on the face of it, provide a sort of white label banking solution, but where that white label banking solution is pushed out to a third party, even that sort of stuff can work. So the financial services space, you need to be careful. You need to get advice to understand what exactly it is that you're doing. But actually, a lot of fintech businesses will quite comfortably qualify. We've talked about investors having full risk ordinary shares. They have to not have any protections in place. A company raising tax relief must have what's called a UK permanent establishment. This is pretty straightforward if you are a UK company, because in almost all circumstances, you should have a tax basis here, which is what we're really talking about. It's worth saying, though, if all of your directors were living abroad, and if you had no employees in the UK and you just had a UK company, it is potentially the case that you don't have a permanent establishment in the UK. So you do need to just be a little bit careful if you have a UK company but you're all living abroad. If that is the case, then talk to a lawyer or an accountant about it, because you can fall foul of the rules. But the principal reason why I raise this is foreign companies are able to raise investment from UK investors and have those investors claim tax relief if they have a permanent establishment. And what the permanent establishment means is that they have an office space in the UK, and that can be a serviced office, it can be a sort of a WeWork, something like that. So they have an office, they have key members of the team in the UK, which generally is senior people. So it's generally a founder or a key officer based in the UK. And they have a genuine commercial reason for being based here. Wishing to claim tax relief is not a genuine commercial reason. So you need to have a business narrative as to why you need to be in the UK. Classic justifications are, you know, they need complex tech provision, and that's sort of best done in the UK, and the best people are based in the UK. You find sometimes that, well, often that the UK is a core market, and therefore they need to have key people based here. So genuine commercial decision is the crucial point. As long as you have that permanent establishment, you can be a foreign company and issue shares to investors in your company and still claim tax relief. So again, if you are in that sort of situation, you know, talk to us afterwards. But that is a way to be able to qualify for the tax reliefs. The final thing I wanted to talk about just on this was what's called the growth requirement. In order to qualify for tax relief under the EIS scheme, so the bigger scheme, a company needs to demonstrate that the money it raises from investors will lead to organic growth of revenue, customer, and employee numbers. If you can't demonstrate that, you don't qualify for the tax relief. And actually, just to warn you, if you take on the investment, the investors are granted tax relief, and it is subsequently found that you don't meet the growth requirement, then HMRC are actually entitled to withdraw that tax relief and to cancel it, at which point the investors have to repay the money to them. Now, to be fair, that's pretty unusual. It generally would only happen where you've outright lied to HMRC or something quite dramatic has happened, but it is possible and it's something to be aware of. So what you need to demonstrate to HMRC is that the money will be used for growth and not for working capital purposes. And the reason this is so important, there are sort of two scenarios where people are caught out by this. The first one is COVID related. Imagine that you operate a restaurant. So restaurants and bars generally will qualify for SEIS and EIS. You've had a restaurant during COVID. Predictably, I'm sure a lot of restaurants have run up large amounts of debt. So what they might be tempted to do is, in order to recapitalize their business to get up and running, they take on investments, and they expect that their investors will be able to claim tax relief. If the money that they raise is used to pay off the debt that they accrued during COVID, and or it's just used to pay costs on an ongoing basis, they don't meet the growth requirement. The growth requirement requires that the use of the money leads to organic growth in revenue, customer, and employee numbers. So that's the first scenario. The second scenario is what HMRC originally were trying to shut down. So what you had was a lot of startups who were only surviving because they were raising investment. So they were basically loss-making businesses. They got to a certain level, I don't know, they had 10,000 users, but they weren't able to grow that user base. They were consistently loss-making, but they were raising investment in order to stop themselves going bust. And HMRC very clearly said, that doesn't meet the growth requirement, and we would rather those businesses go bust. Why? Because the government are giving away huge amounts of tax relief here, and they're only doing it if they're going to see growth in employee numbers, effectively growth in taxation in the long run. So businesses that are just trundling along and not really getting very far, not what they're trying to achieve. So those are the sort of key things on the growth requirement. Really important to remember it, because HMRC are getting hotter about checking this kind of stuff and potentially withdrawing tax relief if they're not happy. Investors, when you come to raise investment, will want to see that you're qualifying for these schemes. So angels will obviously want to claim the tax relief. They'll want evidence that you qualify. And so what they will ask you for is something called an advance assurance. An advance assurance is a dull, really boring one-pager from HMRC, which actually these days is generally an email, not even a letter. But it's basically confirming that you carry on, or your company carries on, a qualifying trade, so a trade that falls within the rules of the scheme. In order to get an advance assurance, what you have to do is send in an application to HMRC requesting that they give that letter to you. Now, what you have to do is slightly different for SEIS and EIS. HMRC publish some forms which theoretically you fill in and send to them. They are actually extremely unhelpful because the forms are really simple. It's all part of HMRC's attempt to make tax accessible for everybody. What they've done is they've created a form that is insanely simple that you fill in thinking it's nice and straightforward. And then if you're unlucky, HMRC sends you back a 14-page letter, or I'm exaggerating, but a really long letter with lots of different questions on it that make absolutely no sense to you. What I would say is, under SEIS, the approach HMRC take is relatively light touch and relatively easy. And if you can be bothered to figure out what you need to give them, and you can sort of look at the guidance and provide the right information to them, under SEIS, it's relatively low risk if you decide you want to do it yourself. I guess the way I would put it, if you screw it up, you're going to get, HMRC will either reject it or they're going to tell you that you need to provide further information, at which point, if you're sensible, you get a lawyer to help you. If clients screw it up, it can be terminal, because sometimes we can't get you out the hole you dug yourself into, but it's relatively unlikely if you sort of do it properly. Obviously, by the way, guys, I would advise you to get lawyers to do it for you, because it's always going to be the better approach. But I'm aware that, you know, sometimes, you know, you don't necessarily have the money to pay for lawyers. And so doing the SEIS one yourself is comparatively low risk. I'd strongly advise against anybody doing the EIS one themselves. The reason is that the amount of information that HMRC require is a hell of a lot more detailed. They need to have evidence around the growth requirement. They need to have evidence about how the money will be spent. If you're doing something that has some aspects of it that may be non-qualifying, then there's a fair bit of legal analysis that sits behind it. And one of the things that we found is that people will send in applications for EIS and HMRC will reject it. And often they've told HMRC something in slightly the wrong words. HMRC have got the wrong impression, and that can cause quite a big problem down the line. It can be very difficult sometimes for us to talk HMRC back round. But actually, even worse, they've sent something into HMRC. HMRC have granted the advance assurance. They've come to claim tax relief, and HMRC have come around and said, actually, no, we're not giving you tax relief because you didn't give us the right information or complete information when you sent in the advance assurance. EIS is complicated, and if you don't give all the information to them, HMRC are not tied to the advance assurance. Anyway, my advice would be, if you're doing an EIS round and you want advance assurance, get it done properly. It's not massively expensive, but it will save you a lot of pain and heartache in the future. So the process is, you put all the pack together, send it into HMRC. HMRC take around 4 to 6 weeks to process the request. They're actually much faster at the moment, 2-3 weeks currently, but 4 to 6 weeks is what they advise. Assuming everything is fine, they will then issue the advance assurance. Investors invest their money, sign all the investment documentation. the shares are issued. Then we or your accountants fill in some forms that we send to HMRC on behalf of the company to claim the tax relief. And those are called under SEIS and SEIS 1, under EIS and EIS 1. And all we're doing is providing to HMRC the information they need about the investment. HMRC review it and they send back a letter, which is technically called a Form 2, so SEIS 2, EIS 2, and they authorize the company to issue Form 3s, so SEIS 3 and EIS 3 to the investors. And those Form 3s are what the investors use to claim the tax relief. Now, the Form 3s are available on the internet. You don't need to get them from HMRC, but just to be clear, it is a very serious criminal offence to issue a Form 3 without an authorisation from HMRC. So please, no matter how hard investors are pushing, do not be tempted to do it. HMRC get very, very upset when people issue the forms without their permission. So that's the process. Once the investors have got the Form 3s, they can claim the tax relief in one of two ways. Most investors will just give the form to their accountants, and at the end of the tax year, so probably around about January, when they're filing their tax returns after the end of the tax year, so generally around about January, they will claim the tax relief just in their tax return, and it's generally a deduction from the tax that they would normally have to pay. It is possible to claim the tax relief on an intra-year basis, and if you do that, you get a check back. It's just, from my understanding, most investors don't bother doing it. So, that's sort of how it's done. What you do find is that if you've done an investment round later in the year, you'll get harassed by investors in January because they want their tax relief forms. So just bear that in mind, and if necessary, sort of manage expectations. So that's tax relief. In terms of investment process, it's all theoretically fairly straightforward. So the idea is you identify investors. So you go and pitch to people, you tap up people in your network, you get to a stage where you've got your investors, and you're probably talking to them about the headline sort of key things. So the valuation, how much they are looking to invest, what you're going to do with the money, what your business does, that kind of stuff. Once you have got your investors warmed up and they're kind of interested in investing, at that point, you will put in place a term sheet. So a term sheet is a 2-3 page document that sets out the terms of the investment and the terms of the documentation that the investors will be signing. Very important point, term sheets are almost always non-binding. So you're not entering into a contract when you sign them. That encourages a lot of founders to think that it's a good idea for them to negotiate the term sheet themselves without lawyers helping them. I would say don't do it. Even though term sheets are non-binding, they set the terms of the investment documentation. And it is incredibly difficult when you've agreed a term sheet for the lawyers to then try to renegotiate it. Just because an investor tells you a term sheet is standard does not mean that it is standard or that it's got terms that you should accept. I advise every single person I ever speak to on this, if you're raising with angels, get lawyers to draft the term sheet for you. If you're raising with VCs, get lawyers to review the term sheet. The good news is, in the UK market, term sheets are incredibly standardized at the moment. And any lawyer who does this stuff on a day-to-day basis can spend probably 5 minutes skimming through a term sheet and tell you what's acceptable and what isn't, what you should push back on. As a firm, we view reviewing VC term sheets, frankly, as a marketing exercise. So it's probable in the early stages we're not going to charge you. So talk to a lawyer, get advice, make sure the term sheet is containing the right terms. Once the term sheet's is agreed, then the lawyers go away and draft up the documentation, and that's the sort of the bit where the lawyers properly get involved. You may find, depending on who the investor is, depending what stage you're at, that the investors will do some due diligence. They're basically looking at the sort of the key things. So, do you own your IP? Is your cap table as you think it should be, or as you say it is? Are there any things that are problematic? So, are people suing you? Have you got lots of liability sat there? You'll be amazed how little due diligence is done in the early stages. In fact, for most angel rounds, there's very, very minimal due diligence done. Rightly or wrongly, investors are generally investing in the founders, and they will take quite quick judgments about the founders and the business. So it shouldn't be too expensive and too difficult for you. Sometimes you will appoint or you will choose a lead investor, and that is somebody who theoretically is leading the round. You don't have to do this, and it can really be anybody you want. You don't need it to be the biggest investor. It sort of often comes out of sort of who the investor makeup is. One of the reasons for choosing a lead investor is that the idea is that you negotiate the terms with them and get the documentation agreed with them, and only once it's agreed with them do you push it out to the other investors. And the idea is it sort of simplifies that negotiation process. You don't want to be negotiating with 10 different investors all at the same time. If you're doing a VC round, the VC will almost certainly be the lead investor. So that's sort of decided for you. If you're doing an angel round, you may find that perhaps the biggest angel's the lead, but it could be actually somebody who is perhaps bringing a bunch of other angels to the table. In terms of documentation, the documentation, it varies depending on the round you're doing. For a really early stage angel round, it's probably really straightforward. Term sheet, a subscription agreement, which is the document that gets the money into the company and the shares issued to the investor. Subscription agreements also often contain warranties. So warranties are statements of fact that if they are wrong, then the investors can potentially sue the founders or the company. So as an example, a warranty might say, nobody is suing the company. If that statement is untrue, because Joe Bloggs is suing a company for 20,000 quid, then you would disclose to the investors that that's untrue. You tell them about Joe Bloggs, and that would remove your liability going forwards for that particular point. So that's a subscription agreement. Most angel rounds, there will also be a shareholders agreement. That basically regulates the relationship between the different shareholders. So it sets out the rights of each of the parties. It sets out, things like who will be directors, how the business is run. It may contain a list of matters that need investor consent. So those tend to be big ticket matters. And then the final thing on angel rounds tends to be articles. So every company automatically has articles of association. You get them on incorporation, and you probably have the standard default ones. The articles basically set out the rules of the company. So, how do you have shareholder meetings? How do you appoint directors? How do you remove directors? All of that kind of stuff. When we do investment rounds, we actually change the articles to build in a bunch of share transfer restrictions and some share rights. So probably in most cases, what we're doing is building in additional protections for the founders to make sure that investors can't just unilaterally sell shares to competitors and do things that might be problematic. For VC rounds, we may have additional documentation. So we have often called management right letters, which are letters that give the VC the rights towards management to get certain information from management. We may have sort of more complicated documentation floating around. That's always very sort of specific to the transaction. But at a high level, those are sort of the key documents. Before going on to the sort of formula point, which we'll finish off with, and then we'll take some questions, I just wanted to talk briefly about advanced subscription agreements. And that is because I think they are sometimes a bit of a red herring. There are some, one particular sort of precedent website in the market who quite heavily pushed advanced subscription agreements as this sort of solution to raising investment without setting a valuation. And they're quite sort of, a lot of founders will come to us and say, oh, I want to do this by an advanced subscription. I would actually advise against it in almost all circumstances. And I'll sort of let me explain what they are and let me explain why I think that they're not necessarily the best idea. So if you think about a standard subscription, what is happening is you are saying to an investor, I want you to invest, I don't know, £100,000 at a £900,000 valuation. That's £1 million post money. We'll talk about the maths in a sec, but you're going to get 10% of the company. Nice and straightforward. We all know what it is that we are getting. Now, sometimes you may be in a position where you think to yourself, right now, my valuation, what I'm being offered by investors or what I can get investors to invest at is really rubbish. But if I was able to bring on some money, spend that money, I would be very, very quickly be able to accelerate my valuation. So in my example, rather than having a valuation of 900,000, I might be able to get a valuation of 2 million. If I could just have that 100,000, spend it, I could have a valuation of 2 million. So what you want to do is you want to put off the valuation. And you can do this through an advanced subscription agreement. So what an advanced subscription agreement is it's an agreement that says, I, the investor, invest £100,000 in your company right now, today. That money is not refundable. It isn't a loan. It's not refundable. It will only be used to buy shares in the company at a valuation to be agreed in the future. So we're not valuing a company today, we're valuing it later down the line. And generally, the valuation is triggered by the next investment round that you do. So the way it's normally done, we say 100 grand invested today, it will convert, it will be used to buy shares in the company at a discount, 20% discount to the next investment round price. So what you're hoping is that by the next investment round, the valuation of the company will be so much higher that even with the discount, you're still getting a better valuation and a better deal than if you took money by way of straight equity today. Now, an advanced subscription is qualifying for SEIS and EIS. So investors can still get their tax relief if they use this structure. But, very, very important but here, if they want to qualify for this, for SEIS and EIS, the shares must, in every single circumstance, be issued by no later than 6 months after the earlier of the date of the advanced subscription agreement and the date they paid the money to the company. So you've got that 6-month window. If you miss it by a week, almost certainly HMRC will not allow the tax relief. The second thing is that advanced subscription agreements have to have specific language in them that says, as an example, that they cannot be amended in any circumstance whatsoever. And if they are amended, then it voids the tax relief. So the reason that people use advanced subscriptions is to be able to delay the valuation. And they generally are people who want to claim tax relief, or the investors want to claim tax relief on their investment. So you chuck in place your advanced subscription agreement. The problem you've got is that you need to remember that the shares must be issued within 6 months. And if you screw it up and get it wrong, you've got really upset investors. But point two, you need to raise a round within 6 months that triggers the conversion at a valuation that is sufficiently higher that you're getting a higher valuation than if you took the money today. And I will tell you from bitter experience, very, very few startups do this. It's very difficult in practice to raise a bigger round within 6 months. You know, things take over, you just do not get around to it, or you don't get the valuation you want. So my advice would be, if you're going to use an advanced subscription, you need to be extremely confident that you will be able to raise that additional round, because you're introducing a lot of risk into the equation. If there's any doubt, frankly, just take the money at the valuation you're offered today, get it done, make sure the investors got their tax relief, and everybody is happy. Final topic then, before we go on to questions. Valuations and how do you calculate it? I'm sure that for many of you, this is literally me teaching you how to suck eggs, but let me just go through it anyway, because it is something that more than half of our clients get wrong, and sometimes with really unfortunate and very, very costly effects. So the key mistake here is talking to investors about the percentage that they will receive when they invest in your startup. Never, ever talk about percentages. The reason is because if the size of your round increases or decreases, the percentage you quoted will automatically be wrong, because more money will have gone into your company. So what you should talk about is the valuation. When we talk about valuation of a company, we're talking in sort of technical terms about the pre-money valuation. So that is the value of your company today before any investment money has gone into it. And for my purposes, to make my life nice and easy with the maths, let us imagine that we have agreed with our investor that the pre-money valuation of our company is £900,000. So valuation, 900,000. The post-money valuation is the valuation of your startup once the investment round is complete. So once all the money has gone into your company. So if I've got an investor who is investing £100,000 into my startup at a pre-money valuation of 900,000, my post-money is £1 million. And this is the crux of it. When we calculate the percentage that the investor will receive, we use the post-money valuation as the reference. And so the maths would be, in my example, 100,000 divided by a post-money valuation of £1 million gives the investor 10%. And as you can perhaps imagine, the mistake people make is they say, investor is investing in a 900 valuation, they're investing 100,000, the percentage they get is 100 divided by 900, which is 11 or 12%. That's wrong, it's 10% because it's 100 divided by the post-money valuation. But as I say, try and avoid percentages, because what you'll often find, you've got your investor coming in with 100,000 and then he brings in a mate who invests, another 100,000, and suddenly the percentage the first investor gets is 100,000 divided by 1.1 million, which is 9 point something %. So always try to avoid percentages if you can. If you do need to calculate the price per share, by the way that you do it is the pre-money valuation. So in my example, 900,000 divided by what's called the fully diluted share capital. So that's the issued share capital, the number of shares in issue, plus any option pool. That's the fully diluted. That gives you your price per share. And you can always check that you've got everything right by you get your price per share, divide it by the amount that's being invested by the investor, and then take that number of shares and divide it by the new total and see if that gives you the percentage that they should have got. So anyway, incredibly exciting calculations, but yeah, very, very important. I very excitingly wrote a book last year. It is the best book ever written, if I say so myself. It's an Amazon bestseller, it's won a bunch of awards, but on a serious note, it actually covers all the stuff that we just talked about. So there's sort of two sections to it. There's a section that talks about the key issues that you need to think about when you set up your startup and get it up to the point of launch. And then there's the second section which talks about raising investment. The book goes into a lot more detail than the things we just talked about. If you do want more information, then yeah, feel free to grab that off Amazon, and it's available in print or electronic version. Cool. All right. I am going to hand over to Dan, who is going to ask any questions that you guys have got. If you do have questions, then chuck them into the chat box and Dan can pick them up and ask me. Cool, Dan.
Hi, Mike. Thank you very much. We've had a few questions through. The first one is from Carlos Wu, and he asks, did Brexit affect the volume of VC funds in the UK?
So was that Brexit?
Yeah.
Yeah, it did. And actually, amusingly, I am moderately anti-Brexit, but actually it was beneficial. What you found was, if you think about all the chaos before Brexit, everyone was worried about access to financial services and UK market. A lot of the VCs set up, so a lot of the EU VCs set up UK operations, funded them with lots and lots of money, and now, of course, have to spend that money and invest in startups. So what you actually have is some really big, really active EU VCs who are investing in UK startups. On top of that, I think you've also got the EU VCs who are not structured through the UK also investing a lot in UK startups. So yeah, look, overall, Brexit has probably been good for the sort of investment market, though in every other way it's probably been pretty dreadful. But we try to find some small positives with Brexit, right?
Great, thank you. The next question is from Rohan. I think it was framed when you were talking about a permanent establishment in the United Kingdom, and he asked, can it be a sales office for a deep tech company outside of the UK?
So it's not true to say it can't be a sales office, but it's probably quite difficult to make it work. So HMRC do not view sales in and of itself as being sufficiently important to justify a permanent establishment. So you would really want something. You would want something more than that. So having a sales team is obviously helpful. It's a part of the argument for permanent establishment, but in and of itself, by itself, it isn't going to get you there. You're going to need to sort of have some other presence and crucially some one or more important people, which is probably directors if we're all being sensible.
Okay. The next question is from Tony. He asks a sort of more general question legally. How much would a lawyer charge to review a term sheet? Would they charge on a sheet by sheet basis, or if they have 3 at once, can they review all 3 at once?
Yeah, I mean, look, it depends on the lawyers. As a rule of thumb, you'll find that firms who don't do as much work in the space will probably charge you more because it takes longer for people to sort of go through them and figure out what they think is market standard and what isn't. With us, I'm not going to say that we'll do it for free because it really does depend. But I mean, often we view this sort of stuff as marketing. And if a client pops over a term sheet and says, what do you think? We'll more often than not be happy to pop an email back and say, look, it looks pretty standard. Maybe push back on X, Y, Z, and we'll jump on a call, to talk through it if that's helpful. But I guess if in terms of the direct question is sort of charging for it. I suppose, I mean, most lawyers, if they're going to charge you, they're probably sort of looking at how long it takes to review it. So, if you've got 3 completely different term sheets, it's probably effectively sort of 3 costs. If they're all pretty much the same, then it shouldn't be too much. But yeah, I mean, the best thing to do, by all means, drop term sheets across to me or across to the office at email, and I'm very happy to have a quick look, and we can jump on a call at some point. Jump on a call to run through the points if that works for you.
Great, thanks, Mike. The next question is from Manoj. Apologies if I pronounced your name incorrectly there. He asks, at what stage around the time when you start raising money in the United Kingdom should you get a lawyer on board or involved? Should you do this early on, once you start getting some interest, stroke traction, or a bit later?
I don't know about on board. I would say talk to a lawyer at the earliest possible stages, because we can help you solve a load of easy or avoid a load of easy mistakes. We can give you an idea about what sort of commercial terms are. Frankly, we can even probably tell you, who might be the investors in the market to talk to. So, have a talk to people early stage, get a view about what you're trying to do. When you actually need a lawyer appointed and sort of formally doing stuff, really it's probably at the point you start paying is probably you want somebody to review the term sheet or draft it for you, but then it's when you draft up the investment documentation. So that's when you sort of want the formal engagement, if you like. But yeah, again, with us, talk to, if you want to have a chat about sort of what you're thinking about, drop us an email. Very happy to have a call with you and run through stuff, and we can explain process from there.
Okay, I think our final question here comes from BAF, and they ask, is the process for SEIS, EIS different for foreign companies opening a UK branch?
So it's the same process technically, but it's a slightly different analysis, and being simplistic, we have to provide a lot more information to HMRC. So the actual route to get the advanced assurance is identical, but the information presented to HMRC is quite different, and will feel, it's a lot more information that goes into them. Again, if you want sort of help on that, drop us a note, and we can jump on a call and talk to you about it.
Great, thank you, Mike. And sorry, I think one final question has come through here from Tony. He asks, is there any difference in terms of cost and workings in the law side between working with lots of different angels compared to a syndicate like Seed Camp?
Yeah, I mean, there is and there isn't. So generally, if you're doing an angel round with lots of different angels, in my experience, you will probably want to try to get one of the angels to be almost like a lead investor, bounce any sort of commercial terms off them, and then almost present it to the other angels as being a sort of fait accompli, take it or leave it. You don't want to negotiate with 10, 20 different angels, but actually in my experience, angels are remarkably chilled about this kind of stuff, and they generally don't have the time or the inclination to get lawyers engaged to go through long review processes of documentation. They're generally very happy to skim through it themselves, and as long as it matches the term sheet and is obviously not offensive, then they'll pretty happily sign up to it. When you've got syndicates, it depends on the syndicate. Some syndicates have their own sort of standardized documentation, so CCAMP have their own sort of precedents that they tend to work from. Other syndicates will be completely chilled and will be happy to sort of go along with what the company proposes. So it does depend. I suspect probably that the sort of idea behind the question is it better to use a syndicate or better to use individual angels? I don't think there's much of a difference, to be honest. I think it depends on where you get the best terms and what you think is sort of best makeup for your business.
Tony has a follow-up question. He's asked, do we ask law firms such as Buckworth to vet and do our own due diligence on potential investors, or is that more a job for accountants?
Either or. I think it depends on what you're concerned about, what you're trying to get at. So automatically, we are required to do anti-money laundering checks, which involve, very simplistically, involve us IDing the investors. So they get a link to the money laundering software we use, they upload an ID and they provide their address, and then we run all the information through electronic databases that are checking for things like terrorism, money laundering flags, if they're sanctioned individuals, if they have a connection to Russia, those sorts of things. And then we would generally do basic source of funds checks, which for people investing fairly small amounts of money is just a sort of a common sense understanding of where the money's coming from. It's slightly different for very high net worth, but actually for very high net worth, you can normally publicly figure out where the money's coming from, and it sidesteps some of those issues. So that stuff quite routinely done, always done. If you want something more in depth, we can do it. I'll be blunt, it's pretty unusual to go into too much depth on investors, but it is something that can be done, and I don't think it makes a huge difference if it's done by lawyers or accountants, to be honest. Yeah.
Thanks, Mike. Rohan has asked, how is the relief process in the European Union? Is it similar to the process in the UK for SEIS, EIS? What are the differences?
It sort of depends on the relief. So different countries have got different schemes. Ireland, for example, has something incredibly similar to EIS, and it's an almost identical process to the UK. The French have a very, very different process, completely different to the UK. And I'll be completely honest with you, not something that we get involved in, because if you're doing stuff in France, for example, you're using French lawyers. So yeah, sorry, Rowan, don't know too much about the sort of tax reliefs outside the UK.
Mazonas asks a slightly different question. Any advice on share option agreements? How do early investors view a startup that has issued several SOAs to their early employees? I don't think there's any problem of issuing options to early stage employees. I mean, investors want to know that team members, particularly valuable team members, are appropriately incentivized, and that's generally done through options or sweat equity. So I think most investors would view it as a positive. Obviously there are ways of maximizing sort of retention, if you like. So you probably want to make sure that the options are done in a way that doesn't give away equity unnecessarily and encourages people to stay. But in principle, I think it's probably a good thing. The other thing to remember is investors coming in, they're not really diluted by the existing options because they're built into the fully diluted share capital. So they will invest as if those options are fully exercised. So it doesn't really make a huge difference to them if there's a load of options in place, because it doesn't really impact the value at which they invest. Great, thank you, Mike. I think that wraps up our Q&A session. If anyone has anything that they didn't want to ask in the chat or publicly, then please feel free to email Michael at his direct email address. I think that's been dropped in the chat already, or you can contact the main office here at Buckworth. I think the details are also available in the chat. But thank you all for attending here this evening. If you'd like to engage with us on social media, then please do so. As I say, notification of more of these events will be posted on there, and I think details of our socials will also be placed in the chat too. But thank you very much, and have a good evening all.